webinar, Forex outlook for the week. So let's start our presentation and have a look at the slides I have prepared. So this is the Forex outlook for this week. We cover the period from October 10th, which is today, to October 14th, which is Friday. Today we will speak, as usually, about the fundamental factors which determine the moves of the major Forex currency pairs. We will discuss a technical picture and define important technical levels. And also we'll try to combine the techniques of fundamental and technical analysis to find out the trade signals and the best trade ideas for this week. I usually plan my trades in advance just to know what opportunities I will have during the week, and this is what I advise all of you to do, to be prepared and to prepare for the trading week. So our agenda, as usually, is the following. Firstly, we discuss how the market is positioned. We see what are the actions of large players and try to make conclusions of these actions. When we study economic calendar to be prepared for economic releases, as these releases have great impact on currencies, then we switch to MT4 and study the charts. And finally, at the end, we summarize everything and our trade ideas. So we saw that the past week was a rather volatile week for the market. We can see that there were great moves in GBPUSD, almost 4% decline in the British pound, and also spot gold price made a big move. We saw that here we have a decline of more than 4%, almost 5%, and a very interesting dynamics. We will talk about gold and pound in greater detail. All in all, we can see that the US dollar managed to strengthen versus its counterparts, and actually American currency strengthened in all the major currency pairs. So we will find out why it happened. Let's have a look at CFTC data. CFTC is Commodity Futures Trading Commission, and I remind you that this commission releases data about the market's positioning every Friday. The period of the release covers the term from of the week, which ends at the Tuesday or at the Tuesday, yeah, of the week in question. So these are the data of the week which ended at October 4th. Here we can see that despite the time lag I've mentioned, the data offers us some information on the key currency pairs and how the market sentiment is moving. First of all, we can see that the overall net bullish dollar position increased a bit, and this corresponds to increased demand for the greenback. When we can see that there were the overall bearish sentiment about such currencies as Canadian dollar, New Zealand's dollar, the European currency, and the British currency. And this bearish net position is increasing in euro and British pound. Also, we can see that Australian dollar was positioned rather well, and it explains the relative resilience of Australian dollar. And for dollar yen, the net bullish position has declined a bit, but still remains sizable. I think that the next data will show that yen bullish position has contracted further, but still there is space for Japanese yen to lose more ground versus the greenback according to this data. Also, the shorts on euro are rather high, so probably we won't see big increase in this euro short positions. While as for British pound, here we can see that the market will probably add more short position in the coming week. Now let's have a look at the US dollar index. We saw a sizable growth last week. The indicator, which tracks the dynamics of American currency versus the currencies of America's 6 main trading partners. The gorge moved to the resistance line, which is in place since the end of last year. US dollar has actually tested levels above this resistance line, but didn't manage to close above this line. So it means that we don't have a clear breakout of this medium term, even long term in some case, resistance. We'll be looking at how the US dollar behaves this week. If it managed to show us a weekly close above, let's say 96.70 and better above 97 mark, then we'll get a positive signal, and next targets for American dollar will lie around 98 and probably higher at highs of 2015 around 100 points. For now, we can't say that the US dollar has chosen this bullish path. There are still doubts because there wasn't a weekly close above the resistance level, and it means that the US currency is actually vulnerable to test lower levels to return to its consolidation range within this triangle, which is painted at the chart, and to slide to levels around 96 and probably even 95. At these levels, US dollar index will have support. Oil prices continue to be surprisingly resilient. We can see that Brent oil is trading above $51 a barrel, and of course this is a supporting factor for riskier assets, currencies like Australian and Canadian dollar, but this factor of better commodities is now fighting with the expectations of the Federal Reserve's interest rate hike in December, which is on the contrary a negative factor for commodity currencies, and that's why we don't see these bullish moves in Australian or Canadian dollar. I think that oil prices are currently a bit vulnerable for a retreat back to $50 mark for Brent oil, and of course this will be positive for American currency and negative for commodity currencies. As for the US dollar, here of course the Federal Reserve is the main driver of the market sentiment and the dynamics of this currency. Here on the right, we have a histogram showing how the market is pricing in the possibility of the Federal Reserve's rate hike at December 14th meeting. This meeting is not the nearest meeting of the Federal Reserve. We will have a meeting on November 2nd. However, as the US presidential election is scheduled on November 8th. No one really expects that the Federal Reserve will tighten policy ahead of the elections. If we make this a bit sideways step and talk a bit about US politics and how the situation develops in America, we can say that Hillary Clinton is now rather confidently ahead of the Republican candidate Donald Trump. This is considered to be good for the market because the future actions of Hillary Clinton, her policy approach, seems to be more comprehensible for the markets, and it represents the less risky continuation of the current policy of the US presidential administration. So the current lead of Hillary Clinton is a positive factor for the US stocks, and it puts some pressure on the greenback. US dollar would show more gains if Donald Trump was ahead and if his chances to win the election were greater. We know that Donald Trump is against America's trade agreements with Canada and Mexico. Mexico is especially unfavored by Trump. So in case of his victory, we would see stronger US dollar and weaker emerging market currencies. However, the recent second round of US presidential debate, which took place on Sunday night, once again showed that Trump is weaker and less persuasive than Hillary Clinton. So we saw that US dollar declined a bit versus Mexican peso, which is believed to be a better indicator of how the market is evaluating the chances of Donald Trump to become US president. So for now, the risk of Trump, let's call it this way, has diminished, and the situation is more stable for American stocks, but less favorable for the US dollar. Somehow this a bit decreases the demand for the US dollar. The fact that Hillary Clinton is ahead, and some analysts and experts even say that the results of the election are already clear, so that Hillary will win. However, I think that the Federal Reserve will still think that until we know for sure the results of election, until November 8th comes, risks exist. We remember that Brexit vote to leave the European Union was still very surprising for everyone, and always the risk of surprising outcome of the US election will exist. So that is why the Federal Reserve, in my opinion, won't raise rates at November 2nd meeting. So the main focus is on December 14th. And here we can see at the chart that the possibility of the US rate hike has sizably increased. A week ago, it accounted for about 50%. Now we are talking about 60%. This data is accumulated from the futures on the federal funds rate. So that is how the market is evaluating the possibility of the rate hike. We see that 60% is not 90%, and here is potential for these expectations to increase. It will happen if we'll see more positive data coming from the United States. This possibility will keep rising, and this will be a bullish factor for the US dollar. On the other hand, we saw that on Friday, US labor market data came out a bit weaker than expected. Here on the left, I have the chart of US non-farm payrolls. And in September, the indicator rose by 156,000. It means that American economy created 156,000 of new jobs. While the forecast was higher, it was 171,000. The market was a bit disappointed, especially taking into account the fact that the US unemployment rate increased to 5%, while the consensus was that it would stay at 4.9% level. Average earnings indicator rose in line with expectations by 0.2%. This is a good moment in the overall weaker US data. Despite some initial reaction of the market, some selling of American currency, which gave opportunity for traders to take some profits on the US dollar and to organize a kind of consolidation in several currency pairs, in British pound US dollar pair, for example, and in gold price, which also made a big move versus the US dollar. Despite this fact, I believe that the data from the US labor market are generally in line with the prospect of December rate hike. We can recall the fact that the Federal Reserve Chairman, Janet Yellen, said in August that American economy needs to create just under 100,000 jobs a month to be healthy and to be in a good and stable state. And we see that it is not under 100,000, it is more, it is 156,000, which calls for the Federal Reserve's rate hike. I have read some opinions from the leading economists who say that actually it is time for the Federal Reserve to raise rates because the low rate policy of the US Central Bank has inflated American stock market, and now we have unreasonable readings in US stocks. The capital market is no longer fulfilling its function of being a place where market participants can allocate capital in the most efficient way. Because of this artificial stimulus from the Federal Reserve, there are problems with financial markets. So in my opinion, the December rate hike is a very realistic scenario, and the Federal Reserve is moving in that direction. So all in all, despite some short-term negative reactions in the US dollar, I remain bullish on this currency and think that it is currently undervalued and will gain more the closer we are to December. In the near term, we probably will see different dynamics of American currency versus different other currencies, and we'll discuss this in greater details when we will be looking at the price chart. Now, let's talk a bit about the economic calendar. Here are the highlights of the week, something you have to be aware of, even if you maybe don't trade the pairs. The countries of which will release this information, because some of these events can have a systemic and great impact on the market. And even if you use only technical approach to your trading, not fundamental one, Sometimes you have to be aware of the news releases just in order to maybe close your position ahead of the important news event, because these events can bring unpredictable forces to the market, forces which can derail your trading system and lead to losses. So I strongly recommend you to follow the economic calendar. So what do we have coming? On Tuesday, Germany will release economic sentiment indicator. Last week, data from Germany was rather well, so it is interesting how the things are with this indicator. On Wednesday, we'll probably get the most important piece of data of the week. It will be FOMC meeting minutes. I can remind you that in September, the Federal Reserve left interest rates unchanged. It changed its forecasts for the federal funds rate. Still, these forecasts are in line with December rate hike, and it will be interesting to know in greater detail how members of the Federal Open Market Committee evaluate US economy and what exactly they think about the monetary policy steps which the regulator will have to take. So this FOMC meeting minutes should provide us with some insight in the Fed's policy making. Of course, this is a rather limited insight, and we should admit that, but still it is more information than we already have, and we have to be glad about it. On Tuesday, don't miss China's trade balance. The latest data from China weren't big market movers, but in my opinion, trade balance is probably the main thing which is important for Forex traders, because China has strong trade connections with some of the major economies, and probably the greatest impact of China's trade balance will be on Australia and New Zealand. These nations are located near China, and that's why their volume of trade between these countries, these economies, is greater. As a result, we will watch China's imports to see if this indicator has increased or decreased. If it has increased, it means that potentially more Australian goods are delivered and bought in China. If it has decreased, then it is not good for Australian exporters and Australian economy in general. So don't miss this data release, which will be early during the Asian session on Thursday. Also, we have traditional US unemployment claims release and crude oil inventories data. This time, the data is released on Thursday because the week starts with US bank holiday on Monday. Today, America is celebrating Columbus Day, so all releases which usually on Wednesday are transferred, are delayed to Thursday. This oil release, I mean. On Friday, there will be a block of US statistics, US retail sales, producer price index, and consumer sentiment. Consumer sentiment is flash, and it is an insight for this month, while retail sales and producer prices are for September. All of these indicators, I think, will be rather important. The Federal Reserve Chair Janet Yellen will offer us some remarks. Probably she will comment on the FOMC meeting minutes. on the recent data from America, including NFP, non-farm payrolls, and the data releases, which we are going to witness on Friday. All in all, Yellen's speech will be in the second half of the trading day on Friday. I think that most of us will close positions by that time, but still we should pay great attention to what Yellen says, as it will have an impact on the market's trading next Monday before our webinar starts. So it is a kind of thing to watch for yourself in order to be prepared on Monday morning. So this was our introduction, our fundamental comments, and now we will plunge into the main currency pairs to see how they are performing at the charts, and to speak in greater detail what are the trade ideas and what are the important levels to watch. I usually begin with weekly charts. It is the best way to start your weekly analysis. And once again, as we have done in the last few weeks, we open the weekly chart of the euro dollar. And what we see here we see that the pair is still playing with this green line. And this line is 100-week moving average. We can see that since the middle of August, the pair is closing a bit higher than this line, then once again falling down, then once again testing higher levels, and so on and so on. This price action near this 100-week moving average on the upside and 50-week moving average on the downside is continuing and continuing. We can see that the volatility in euro dollar in the past few months has significantly declined in comparison just what we had before August, in July, in June, and so on. The volatility is low in euro dollar in general this year, but the past few months are making the record low volatility. As last week we tested support of the 50-week MA and didn't manage to settle above 100-week MA. In my opinion, what we will have this week is yet another week of this small ranges and of trading between these two lines. I simply don't see any momentum here on the weekly chart, and still the pair has scope to stay in this range for a time being. Of course, a time of a breakthrough is coming, it is certainly so. But if we have this support line drawn, we can see that the range is getting more and more narrow. But I don't think that we will get a breakthrough this week. It is unlikely. Probably some major move will happen closer to the US election, or maybe the euro will manage to stay calm until after the election. We'll see that, but in the short-term horizon, I don't think that we can count on a big move this week. To see the picture in greater detail, we visit the daily chart. Here I have some indicators applied. Once again, I have moving averages. The the gold line is 200-day moving average. We can see that the euro is currently testing levels below this line, and we see that during the last 3 days, the resistance is provided by Here we have 50-day moving average. This is this brown line. I think that we are now moving to 1.1120 support. This is the minimum of September 21st and also minimum of August 31st. So it is a rather important support level. Also here we have the blue line. It is the first weekly pivot support line. Weekly pivot indicator showed that the pivot point for this week is lying at 1.1183. We are currently trading below this level, and it means that the euro is in negative territory. Next support levels below 1.1120 will be around 1.1040. This will be a rather sizable decline. I think that the euro is currently more vulnerable to a decline than to another attempt to show some growth. All in all, here on daily charts, the moving averages are almost horizontal, so potential for great volatile move is limited. Last week, we had some interesting dynamics on the single currency. The euro got a boost and managed to recover from lows. I mean, these lows of this candle, red one, on the speculation that the European Central Bank is thinking about tapering its quantitative easing program. Well, it was hell of a news because the market was trying to guess whether the European Central Bank will increase monetary stimulus, not taper it. And some speculation that the European Central Bank is going to taper its easing was really surprising for the market. It was not what traders are preparing for. The information came in form of report by Bloomberg, and according to it, the regulator would start winding down its bond buying by 10 billion euro a month. The program is currently scheduled to end in March 2017. However, this information, this speculation, soon was disregarded, as there was no official confirmation of this info, and earlier the ECB President Mario Draghi has consistently said that monetary stimulus would be extended past March if necessary. Judging by the Eurozone's data, judging by the weak inflation, well, it looks like something is necessary to encourage the European economic growth. However, we see that the monetary policy of the European Central Bank becomes less and less effective, and this explains why such rumors about tapering of quantitative easing come to existence. However, it is unlikely the European Central Bank will allow the euro to strengthen much and to visit levels much higher than 1.13. I think that it creates too much risks for the region's economic growth. So we should look forward to weaker euro and higher US dollar, and to prepare to sell the European currency. I think it can be done at the current levels, and positions may be increased if support at 1.1121 is breached, and in this case we'll have our target at 1.1040, 1.1042. This week we'll watch German trade balance and German and euro areas economic sentiment on Tuesday. These are the main data releases from the euro area. Also, if we speak about euro, we remember that there are concerns about Deutsche Bank. For now, these concerns have subsided a bit as traders see that there are no immediate consequences of the problems of the bank, but still it didn't manage to reach an agreement with the US authorities, which demand Deutsche Bank to pay a fine. So I believe that it is a negative factor. Resistance for the European currency is located at 1.1180 and also at 1.1205, and we have resistance line located near 1.1235. I think this is the limit for the euro on the upside. Let us now switch to British pound. Here we had an extraordinary move last week. We can see that the pair has been consolidating between 1.2840 and 1.35 during the whole time after Brexit referendum. Then we saw that there were two very small candles. Pound was under bearish pressure and unable to show significant recovery and once again visit the upper border of this range. And then came a breakthrough, and I have in my trading terminal the minimum of this weekly candle around 1.2018, but I know that it is a bit different for different brokerage companies. It is, of course, important that after some correction, pound is still trading below resistance at 1.25 mark. So what happened with British pound? We had the more than 66% decline to 31-year low during the Asian session on Friday. This decline took place in minutes, and the decline happened amid low liquidity and could have been triggered by an error of some large banks trader, and then the situation could have been worsened by algorithmic trades which are done in great volume and which could have made this sell-off intensify. An article in Financial Times also cited French President François Hollande, who said that the UK must suffer the consequences of leaving the European Union, and some analysts believed that it is the reason of the sell-off. In my opinion, what happened with British pound could have been an accident. Now this accident is over, and we need to analyze the bigger picture. The bigger picture certainly is that the British pound visited lower levels we haven't seen for ages. It means that the downtrend is continuing and it has force, and that the market has really negative attitude towards British currency and the prospects of the United Kingdom. I believe that for now negative pressure on pound will prevail, and we won't see here some sizable recovery, some reversal. Of course, after this big move, we will see a kind of consolidation, something like the market showed us after Brexit and the following weeks of consolidative moves. We will probably see something like that in the British pound. As for the prospects, we can see that data released in the UK during the past week were mixed. On the other hand, all three PMIs of the United Kingdom, I mean manufacturing PMI, construction PMI, and services PMI, exceeded expectations. But on the other hand, industrial production contracted in August, and manufacturing growth was weaker than expected. Concerns about Britain's future have been mounting. Recent commands of Prime Minister Theresa May increased the risks of so-called hard Brexit that would restrict access to the European Union's single market for Britain, and it is a very negative prospect for Britain. There is opinion that weaker and lower rates of British pound are actually good for the UK economy because lower pound is more beneficial for British exports. However, I must say that the risks posed by the fact that the decline of British pound was too rapid may be greater than the benefit from exports. There are the risks of increasing inflation in the United Kingdom and negative impact on the wealth of British citizens. As a result, it will be probably more necessary for Bank of England to encourage economic growth through lower rates, but it will be difficult for the central bank to cut rate because of low pound and high inflation. So something dangerous may come out of such volatile moves of the British currency. The outlook for pound remains gloomy overall. There were comments that Theresa May isn't planning to negotiate special favors for financial services in the European Union exit talks, and as financial and related services sector accounts for 12% of UK GDP, it is quite easy to see why investors are so concerned about the future of British pound. There was a close of the week below 1.25 mark, and this also represents a bearish factor. In the daily chart, we can see that the pound is below the weekly pivot mark, which is located at 1.2465, and below this level we are vulnerable to decline to 1.20, I'm sorry, and a bit lower. Let's have a look at the 4-hour chart. 4-hour chart, here it is. Oh no, 4-hour chart, yeah. Here we can see that the pound is consolidating just below 1.2465. The consolidation on the downside has some triangle-like fashion. Decline below support at 1.2350 will open the way down to the recent lows, to the first spike down around 1.2230, and while we have 1.2150, 1.20 marks. Resistance is located at 1.2465, 1.25, 1.26, and so on, 1.2769. There will be plenty of resistance levels, and our strategy will be to sell the British pound on its attempt to get higher, or maybe those of you who are more risky traders can sell the pound on attempts to break lower. But in my opinion, safer is to wait for some a bit higher levels of British pound to enter this short position. As for US dollar Japanese yen pair, well, last week it was also moving rather fast. It managed to break above 2016 resistance line. We have spoken about this line for quite a time, and finally the pair closed above this mark. However, as we can see on the chart, the pair didn't close near its weekly highs, and September highs near 104.30, 104.20 turned out to be a significant resistance for the US dollar, and we now need to see close above this mark to actually confirm that the trend in dollar yen is aiming for higher levels, is aiming to reverse its dynamics. For now, we can see some more sideways trading between 104 and 100 mark. Here we have a kind of corridor. It is important to point out that Japanese monetary authorities are probably really glad that the demand for the yen has weakened, as it seems that they are not able to generate the yen's weakness on their own. A weaker yen should help Japanese exporters and encourage their too low inflation. At the same time, the current situation emphasizes that the Bank of Japan lacks power to influence the forex market. We can see that the reaction to the Bank of Japan's policy adjustment was much less strong than the growth of dollar and yen, which we witnessed last week. Let's have a look at the daily chart. Here we can say that the pair returned below 100-day moving average at 103.60 last week on Friday because of the weaker non-farm payrolls data, and now this is important levels, and both have to overcome this level if they want to continue growth. Next resistance, as I have already mentioned, is in 104.20 mark. If this level is successfully broken, then we'll look at higher levels around 105, 105.50 and 106. The board is located near the area of 102. This is the previous resistance and now support line. Also, this is the bottom of the daily Shimoku, and not far from that is another support in form of 1,500-day moving average around 101.70. Note that even though dollar yen can keep trying to show short-term gains thanks to the external environment such as higher oil prices, the longer-term bullish move will unlikely be sustainable, as there is no additional fuel provided to the pair by Japanese side of things. The Bank of Japan's monetary authorities don't cheer the market with news of new monetary stimulus packages. It seems that the Bank of Japan has run out of options and has nothing more to offer. At least this is how market is perceiving the situation. So the pair really lacks bullish driver from Japan. And of course, US dollar can strengthen on the expectations of US rate hike in December, but this growth won't be as rapid as it would have been if Japan was successfully easing policy, if the monetary policy of the Bank of Japan hasn't been already that loose, and if the regulator really had opportunity to act in this field. But it seems that it doesn't, so this is why the upside for the pair should be limited. There won't be many news from Japan, so focus on the US releases. On Tuesday, Japan will publish current account figures and economy watcher sentiment. Tertiary industry activity is due on Thursday. Also watch China's trade balance on Thursday and inflation on Friday, as these figures will have an impact on the market's risk sentiment and consequently on Japanese yen. And a couple of words about Australian dollar, our commodity currency. Well, what we saw next week wasn't really surprising, in my opinion. Despite some attempts to break a big resistance line to the upside, we see that the main obstacle for the pair is provided by the level of 0.77. I think that some large shorts are located here, so the market isn't moving much above this level. I think that this point will still be an upper limit for Australian currency during this week. Also, if we have some deterioration in commodity prices, then Australian dollar will likely retest 100-week moving average around 0.7530. This should be the target. This is the pair has support. As for the daily chart, we can see that last week the pair fell below 50-day moving average. This week, this level represents resistance, is located around 0.76, and as long as the pair is trading below this mark, it is vulnerable for a decline to 0.7520, 0.75. This is support line of 2016. I believe that these are levels to target if we are selling Australian currency. Here the pair should find some good support, so I don't recommend you to set some bigger targets. Above 0.76, if there is some good data for the market's risk sentiment, then the targets, the bullish targets, should be in turn limited by 0.77 mark, as we have already said that it is kind of obstacle which proves to be really strong for the bulls, and I don't believe that they will be able to overcome this level this week. So once again, once we reach 0.77, once we approach this mark, it is a wise idea to put a sell order here. All in all, data from Australia were rather well, but the market was kind of ignoring this data and watching the developments in expectations on the US Federal Reserve's rate hike. So I think this trend of more important American data will continue into the next week. And a couple of words about gold. We spoke about it a bit already when we saw that it was one of the assets which made the biggest moves versus the greenback in the past week. We can see that gold has kind of breached the bullish trend which was in place this year, and it is a significant change in what is happening in the market. On the one hand, the negative factor for gold is the expectations of the Federal Reserve's rate hike. On the other hand, concerns about Brexit remain, and this concern may give gold some some potential for recovery. For now, gold is limited on the upside by 200-day moving average around 1,259, and we have to break above this level to recover, to test levels around 1,300. This is the key resistance level for the asset. Here we will find new short position, I believe. And for now, I can say that despite the fact that the asset is oversold, this move to the downside still looks kind of unfinished, and gold is still vulnerable for decline to levels around 1221. The main factor in the short term will be the minutes of the Federal Reserve's meeting, which will be released on Wednesday. This is it. These are the main things I wanted to say about the fundamental and technical picture for the British pound. And let's sum up everything what we have said and see what are the main trade ideas for this week. Firstly, the US dollar was a bit weakened by US non-farm payrolls figures, but I believe that this weakness of American currency is temporary, and that all will depend on the incoming data. For now, what we already had from the United States was in line with the expectations of US December rate hike. These expectations are still not fully priced in US dollar's rate, so American currency has bullish potential. If we look at the euro dollar, the risks are to the downside. We target level at 1.1120, and below this mark, we will target 1.1040. On the upside, resistance is at 1.1180, 1.12, and 1.1230. This is probably the ceiling for the pair this week. Recent comments that the European Central Bank may taper its quantitative easing program are probably just a kind of market speculation, and I don't believe that it will cause any sizable increase in the euro dollar rate further. British pound to US dollar is trying to just somehow recover from the sell-off which took place on Friday. The sell-off may have been an accident, but the overall picture for the British pound still remains rather negative. We will watch 1.2465 and 1.25 as the main resistance levels on the downside, on the upside, I'm sorry, and on the downside, support is located around 1.2350, 1.2230, and 1.20. Dollar yen needs to overcome resistance at 103.50 and 104.20 to show a more sizable increase to 105 mark. The pair managed to break above 2016 resistance line, and there is a good support in 102 mark. Australian dollar is currently vulnerable below 0.7570. We'll look for a decline towards 0.75, and in case the currency managed to recover to 0.77, it will be a good level to enter new short positions. This is it for today. I thank you and remind you that our next webinar will take place next Monday at 12 p.m. GMT. My name is Elizaveta Belugina. I'm the leading analyst at MES. Thank you for your attention, and let's see each other next week. So bye, and have a great and profitable trading.